Good morning, everyone. So today we'll do the last revision session from my side, which is a culmination of all the standards that you would have studied so far. It boils down to the ultimate point that how do I adopt Ind ASs for the first time? So this standard generally we take towards the end because what is important is you get an idea of your ICAP regime from the intermediate that you would have studied, and you get a complete idea of Ind ASs in the final in the chapters that you would have studied, and you are fairly conversant with what are the gaps between the erstwhile regime and the new regime. So the adoption, the first time adoption becomes simpler to understand. And you will know why some adjustments are done in a particular manner as well. So from that perspective, this is the last topic that is normally reserved for the end. All right. Now, from an examination perspective, it is a mid. It comes in the middle category. That means it's not so frequently asked. At the same time, it's not totally ignored. Also, you do have occasional questions that flow in your examinations, but it is extremely important from a practical perspective when you are going in for a transition. Well, already all the listed companies have transitioned into Ind AS regime. So this is not going to be specifically for the existing listed companies, but where your net worth exceeds 250 crores or you are planning on listing, then you will fall under the mandatory applicability of Ind AS. At the same time, you may also choose to voluntarily move towards Ind AS, in which case you will have to apply the provisions of this standard. Now, moving from accounting standard regime to an Ind AS regime is a policy change because it's not every day that you say I will follow Ind AS today, accounting standard tomorrow. You cannot treat it as a change in estimate or some such day-to-day activity. This is a once in a lifetime activity of the company, and it involves making new estimates, making new assumptions, making new workings, new valuations, new measurement principles, new recognition principles, and therefore we commonly treat it as it always should be, that is a change in accounting policy. And you would have studied when you did in days 8 that a change in accounting policy should be done retrospectively. A change in estimate can be done prospectively, but a change in accounting policy requires retrospective restatement. And that is why you not only you not only show the impact for the current year, but also for the previous year. And if you remember in days 8, retrospective amendments would generally be shown by way of a presentation such that the policy was always in force. That means your P&L will be having the usual two columns, that is the current year under the Ind AS regime transitioned, the previous year under the Ind AS regime transitioned, you would do a restatement. Coming to your balance sheet, you will have the current year closing as per Ind AS. Comparative previous year closing also would need to be presented in line with Ind AS for the comparisons to make sense. And you will not only do this, you will present a third balance sheet, that is the balance sheet as at the beginning of the earliest reporting period. In this case, 1st April of the previous comparative period, assuming this is for a 2-year regular balance sheet that you prepare. Okay. Now, if this would be an IPO, a company that is gearing up for an IPO where you are preparing the financials for listing purposes, then you need to present 5 years financial statements for comparison. And when you are preparing the 5-year financial statements for comparison, Then Ind AS you will have to restate for all the 5 years. And from the 1st April of the earliest financial year, you will have to prepare a balance sheet for that as well. So it is a very, very crucial standard to explain how the transition has happened into the Ind AS regime. Now, transitions are not easy. Transitions are messy, transitions are chaotic, transitions are difficult. They are anything but easy. Why do I say it is not easy? Because the whole fundamental construct of Ind AS is very different from what we have studied under accounting standards. For example, for example, you take the case of a simple case like revenue recognition. Revenue recognition, suppose you have an example where I sell a product with a 3-year warranty, right? So I sell I deal in air conditioner sale, and I sold my air conditioners to my customers, and along with the air conditioners I have also given a 3-year warranty. Now under accounting standard, how would this be accounted? I would record the sale the moment the goods, the control in the goods, the title of the goods is passed on to the customer. That means the moment I make an invoice, I will record the invoice value as my sale. So suppose you have your suppose you have a sale value of 50,000 rupees, then you will book the entire revenue of 50,000 rupees. What about the 3 years warranty? Accounting standard 29 requires you to make a best estimate of the provision and take the expense to your P&L. So, excuse me, I just have a slight cold. So if you have sold a product with a 3-year warranty, then you make a provision, a best estimate of the costs that you would have estimated on account of the 3-year warranty that you have promised to provide. That would be a best estimate, and that would hit your P&L, right? So that is as far as your accounting standard regime is concerned. Now, when we talk about Ind AS, Ind AS does not say you record the income based on when the control is transferred. Ind AS talks about satisfaction of performance obligations. Ind AS talks about satisfaction of performance obligation. So today I have two performance obligations with me. One is sale of the air conditioner, and the second is provision of warranty services. Under Ind AS 115 terminology, the sale of an air conditioner is a performance obligation satisfied at a point in time, whereas the provision of warranty services over a period of 3 years is satisfaction of performance obligations over a period of time. So they are two distinct performance obligations, and therefore Ind AS mandates that you have to recognize the revenues also separately to give the reader a better idea of how the revenue mechanics actually flow in my accounts. So the standard typically says you look at the standalone selling price of an air conditioner or the standalone selling price of the warranty services. So if I look at that, then 35,000 rupees will be the selling price of an air conditioner. 15,000 is the warranty cost. So what will happen is, of course, when I sell, at that point of time itself, I will recognize a sale of 35,000 rupees, and 15,000 rupees is what I would park in my books as a contract liability. And this contract liability, I would let it flow into the P&L over a 3-year tenure. That means 15,000 divided by 3, 5,000 rupees per year, it would flow into my revenue. No provision would be required for the best estimate, because in this case, what is happening is you are reducing the revenue itself. So as and when against that revenue you incur any cost in the normal course of accounting, those costs would get booked. So this is a very fundamental change in the manner you account for revenue. Similarly, when you talk about financial instruments, let us take the case of convertible debentures. Now, convertible debentures in accounting standard, they would be recognized as liabilities because there is an obligation to pay until they ask for equity. So we show them as liabilities, and interest is recorded based on the coupon rate. Straightforward. Tomorrow, if they convert, if they apply for conversion, liability will be debited, equity will be credited, whatever premium, if it is there, that also will be credited. Simple, straightforward accounting under the AS regime. Under Ind AS, your convertible debentures becomes a compound financial instrument. It is exhibiting the features of both equity as well as debt. And therefore, the standard requires you to find out what is the effective rate of interest, effective interest rate of a similar instrument which is having only debt characteristics. Using that rate, you will discount the cash flows to the present value, and then you will look at what is the proceeds you have received. Against that, what is the present value? The differential is what typically becomes your equity component and goes and sits under other equity. The debt component, which is the discounted value of the cash flows, will sit as part of your liability, and you will accrue the discount, or you will accrue the interest at EIR in respect of this. And ultimately that grows up and becomes your principal at the maturity date. At the maturity date, if you choose to pay, you pay. If you choose to convert, you convert. But basically, your instrument itself is accounted in a totally different manner compared to your accounting standard regime. These are just two cases where you saw the huge amount of difference in accounting. There are umpteen such cases where you have lot of variations in the accounting. Yes. And because of that, there is one standard accounting approach that could have been followed if Ind AS 101 was not there. If Ind AS 101 was not there, we would have to, as preparers of financial statements, we would have to undergo the painstaking activity of restating each and every financial asset or normal asset, financial liability, normal liability in line with Ind AS requirements. That means, for example, if I have to look at my revenues, if I have to look at my instruments, I will go right to the point in time where they were actually issued, and then I would determine the fair value on that date, do an unwinding of discount to accumulate the value till today, and then pass an adjustment entry. Similarly, for ESOPs or for fixed assets or for anything that is there under the sun in your balance sheet, each and every line item you would sit and analyze. And ultimately, you would analyze from the point it actually took birth in your financial statements. And you would have to do a restatement in line with Ind AS. Would it be impossible? Answer is no. It would be possible. Would it be impractical? Answer is a big yes. I am not here as a finance and accounting team to prepare balance sheets only. We have to look at the business practicalities as well. And keeping in mind this practicality, Ind AS 101, which came from its mother IFRS 1, was brought into force. Ind AS 101 gives us a lot of proxies, a lot of exceptions, a lot of benefits, a lot of surrogate, a lot of advantages. Ind AS 101 basically tells us at the point of transition, how can you remain compliant by not applying fully the requirements of Ind AS? Ind AS 101 tells you that how can you avail certain exemptions and benefits, keeping in mind the practicality that is involved. Ind AS 101 says, instead of going for a full convergence, you can assume a particular value. You can assume a particular treatment. And once that is there, you follow that treatment and henceforth you follow the requirements of Ind AS. So Ind AS 101 is basically a list of items, where you are permitted to deviate from the regular Ind AS requirements only as far as it pertains to the transition. Only as far as it pertains to the transition. Ind AS 101 is not a substitute for future accounting, saying that Ind AS 101 permits this exemption. No, that is only for one day, that is on the date of transition. After that, your regular Ind AS will apply. Is it okay? So that is the fundamental reason why you have your Ind AS 101. Okay. So with that background, let us come to the topic. Yes. Now, when we talk about there are certain definitions that we will have to look at. Okay. Now, first definition, previous gap. Previous gap. I'm using the same study material that is already available with you. Even the last batch, I had used the same thing. You can see the markings also. So no separate material is there. It's the study material itself. Okay. All right. Now, what do you mean by previous gap? Because the new gap will be the Ind AS regime. So what is the previous gap? How it is defined under Ind AS 101? The basis of accounting that a first-time adopter used for its statutory reporting requirements in India immediately before adopting Ind AS. So what was the basis of accounting that you were following in India? That becomes your previous gap. That becomes your previous gap. So generally it would be the AS regime. So companies required to prepare their financial statements in line with section 133 shall consider those financial statements as previous gap financial statements. They were prepared as per company's accounting standards rules, and hence such accounting standards are the previous gap for those companies in India. Easy? No difficulty? Yes. So basically, you will have to look at those standards which are followed prior to Ind AS for reporting purposes in India. You may have a company, a US company that prepares financials under US GAAP also for US reporting requirements, under AS also for Indian requirements. You will have to refer to accounting standards. US GAAP is not concerned with our transition. Are we okay? Yes. So this is the meaning of previous gap. Now we come to the next one, that is transition date. That is transition date. What do you mean by transition date? Suppose I am preparing a balance sheet for the year ended 31st March 2026. And I have to follow Ind AS. So 25-26 is the year in which Ind AS becomes applicable. So 25-26 has to follow Ind AS. If 25-26 has to follow Ind AS, then naturally it means 24-25 also has to be Ind AS. So therefore, you will restate the P&L. Similarly, your balance sheet 31st March 26 Ind AS, Comparative 31st March 25, which was in AS, will now be prepared in Ind AS, a restatement. And you will do a restatement of all these adjustments. You will take it to your retained earnings generally. So you will have a 1st April 2024 balance sheet also at in Ind AS. Okay. So if we have to look at the definition, it is the beginning of the earliest period for which an entity presents full comparative information under Ind AS in first Ind AS financial statements. So, beginning of the earliest period, it does not just confine itself to the beginning of the previous reporting period. As I said, in an IPO, if you are preparing a 5-year balance sheet P&L, then the beginning of the fifth of the prior 5 years, earliest period, that becomes your date of transition. That becomes your date of transition. Are we okay with this? Yes. Are we okay? Any doubts? No doubts? Yes. Okay. Just a minute. Just a second. Just give me 2 minutes. All right. Now, so date of transition is done. And previous gap is done. Now we move on to the next one, and that is first Ind AS financial statement. What do we mean by first Ind AS financial statements? These are the first annual financial statements in which an entity adopts Ind AS. Okay. So in our example, 25-26 was the first annual financial statements in which an entity adopts Ind AS. And there is typically an explicit and unreserved statement of compliance with Ind AS. Explicit and unreserved. You cannot use a statement saying that I have complied with the requirements of Ind AS subject to, say, financial instruments. Not permitted. Everything should be moved to Ind AS and you give the explicit and unreserved statement of compliance with Ind AS. Essentially, compliance with all of the accounting standards. Compliance with all of the accounting standards, and then partial compliance is not acceptable for any Ind AS financial statements. Okay. First Ind AS you mentioned. Second year onwards, there is no need for you to mention because it's already required that you comply with Ind AS. Okay. So that is your first Ind AS financial statements. Then who is your first time adopter? An entity that presents its first Ind AS financial statement is known as the first time adopter. Okay, so that is it. Then first Ind AS reporting period. These are all small definitions which you can go through. Okay, now what is required on transition? Any transition adjustment, and you will appreciate this now better because you know your Ind AS, you know ASs also. So any of these 4 things will happen. Only 4 things are there. इन चारों के अलावा कुछ भी नहीं होगा. Only four things are there. That is, first one, you will de-recognize the items appearing in AS but not permitted under Ind AS. You will de-recognize the items appearing as per AS but not permitted under Ind AS. Second, you will recognize items which are not shown in AS but required to be shown under Ind AS. So first one, AS में AS में था but Ind AS में नहीं चाहिए, so you will de-recognize it, right? So there are some transactions, some balances which are not required under Ind AS, they were shown under AS, de-recognize. Second one, there are some items which are not shown in AS but need to be shown under Ind AS, recognize. So first is de-recognize something, second is de-recognize anything, third one is reclassify. So for example, preference shares was shown under capital. Now you have to show it under liabilities. So reclassify. And last one is remeasurement. So only four things: de-recognize something, recognize something, reclassify something, remeasure something. Apart from these four, there are no any further adjustments that are required under Ind AS 101. यही चार चीजें काफी है. Only these four things are sufficient. Okay. And everything is in these four things. Now, if I have to give an example, items which appear in AS but need not, which do not appear in AS but need to be shown under Ind AS. For example, bills receivable discounted. Discounting of bills receivable. Bills receivable typically would end up appearing as a derecognized item in AS, because the moment you present a bill receivable to a bank for discounting, the entry that is posted under AS is bank account debit, discount account debit to bills receivable, because you submit it to the bank. So when you record a bills receivable, it will be bills receivable account debit to trade receivables. Discounting would be bank account debit, interest or discount charges account debit to bills receivable. Bills receivable gets knocked off. In your balance sheet, it does not appear. But Ind AS tells us that, is the liability really is the bill truly derecognized? Is the bill truly derecognized? Tomorrow, if your trade receivable guy, the debtor guy, does not honor that bill receivable, then the bank will come after whom to recover it? It will come after me, who has discounted the bill. So therefore, is it really correct for you to derecognize the bill receivable? Answer is no, as per Ind AS. You will have to continue to recognize it. Yes. And therefore, it has to be shown in the financial statements. Next, reclassify. I told you, convertible debentures or convertible preference shares, whatever be the case. Okay. Next, remeasurement adjustments. For example, investment in equity shares. Under AS regime, it was always at cost. But now you will have to show it at fair value. I'm not talking about investments in group companies, that is investment in subsidiary, associate, joint venture and all. No, I'm talking about regular investments. Okay, so you will have to do a fair valuation and take the movement either to FVTPL or FVOCI, right? Then biological assets. These are also new things, right? So therefore, all these adjustments have to be made as per Ind AS on the date of transition. If Ind AS 101 is not present, go back in time and find the fair values, adjust it and arrive at the current value. Because Ind AS 101 is there, you have the benefit of proxy values, surrogate values, exemptions, exceptions. All of that is present. So Ind AS 101 simplifies your transition to a great extent. It simplifies your transition to a great extent. Are we okay with this? Yes. Are we okay with this? Any doubts? Okay. All right. Fine. Now, let us get back to some questions before we. Okay. Illustration 2. Company B is a foreign subsidiary of Company A and has adopted IFRS as issued by IASB as its primary gap for its local financial reporting purposes. So, Company B is a foreign subsidiary having adopted IFRS for its local reporting. B prepares the financial statements as per Ind AS. So, A is Indian company, B is the foreign subsidiary. On transition of company A to Ind AS, what would be the previous gap of the foreign subsidiary company B for its financial statements prepared for consolidation? Now, this is a foreign subsidiary. It is preparing as per IFRS for its local compliance outside India. Now, the previous gap of the foreign subsidiary would be accounting standards specified under Section 133 and not the IASB's issued IFRS, because the first time adoption has to be regarded in the context of India only. So this is your first question. Okay, so local your Ind AS financials only will be the first one. Next, we move on to the next one. E Limited is required to first time adopt Ind AS from 1st April. The management has prepared the financial statements and given an explicit and unreserved statement of compliance. Okay. However, there is a disagreement on application of one Ind AS between the management and the auditor. Can such financial statements be treated as first Ind AS financial statements? So I have an entity which has transitioned into Ind AS. Now, because it has transitioned into Ind AS and there is a requirement, the company has given an explicit and unreserved statement of compliance. Fair enough. Now, one matter, auditor does not agree with the transition. There is a disagreement on application of one Ind AS. The question is, can such financial statements be treated as first Ind AS financial statements? Very much. See, disagreements between the auditor and the company will always be there. It has to be there for a healthy relationship, right? Now, the point is this: because the auditor does not agree with a particular treatment, because it does not agree with a particular treatment, can I say that my financials are not the first Ind AS financial statements? No. Auditor has a disagreement. So auditor has a place to express that disagreement. Where is that place? That place is in his audit report. That place is in his audit report. The financial statements are the responsibility of the management. The management says it has complied. The management gives an unreserved statement of compliance, prepared the balance sheet. It will be the first Ind AS financial statements, notwithstanding the fact that the auditor has some reservation. If you concur with the auditor, then you can go ahead and make the changes before the auditor signs off. Before the auditor signs off. But if you stick to your ground saying that what we have done is right, then the auditor cannot force his way to make you to rectify the financial statements to substantiate his point of view. No, you have a particular stand, fair enough. He has a particular stand, fair enough. So my financials will contain the unreserved statement because as the management, I believe it to have complied with the standard. The auditor believes some treatment is not complete. Let him give his displeasure in the form of a qualification in the audit report. I do not have any locus standi in respect of the audit report. I cannot, as preparer, dictate the auditor what he should mention in his audit report. At the same time, the auditor can caution the company that look, what you are not doing is what you are doing is not as per the reporting standards. If the company agrees and rectifies, well and good. If the company holds its ground, it may have some perfectly logical reasoning to do so. And if the auditor does not agree to that, then auditor cannot tell the company this is not your first Ind AS. It will be the first Ind AS. Auditor can put a qualification. Okay, so it's a very beautiful arrangement between the auditor and the preparer that both of their statements hold true. Okay, both of their statements hold true. Okay, now if an explicit and unreserved statement has been given, even if auditor's report contains a qualification, it would be considered that E Limited has done the first time adoption of Ind AS. In such a case, exemption given under Ind AS cannot be availed again. If the unreserved statement is not given, then such financials would not be considered as the first Ind AS financial statements. Are we okay with this? Yes? Is it clear? Any doubts? Okay, illustration 1. This is very simple. Okay, I'll just skip this up. Okay, next. Okay, ठीक. Now, okay. Now we come to certain specific transitory items. Okay, and this is where the standard starts getting important. This is where the standard starts getting important from an examination perspective. Okay. Now, there are all in all, if I am not mistaken, 7 to 8 there are all in all 10 important transitory items guidance that is there under Ind AS 101, which is important for us, which are important for us. So I will be running you through those 10 specific transitory items. Okay, now, first one is ESOPs. Okay, now, ESOPs are covered under which Ind AS accounting standard? Yes. ESOPs are covered under which Ind AS accounting standard? Yeah, Rashmi. Yes, you can unmute yourself, no problem. I will also feel that somebody is there in the class, right? ESOPs are typically covered under Ind AS 102. Okay, and we just did a revision in the last class. So what does Ind AS 102 tell us? Well, Ind AS 102 tells us that ESOPs a form of share-based payments required to be accounted as per that standard. And that standard tells us that you will have to measure an ESOP using the fair value as at the grant date. Using which value? Using the fair value as at the grant date. The fair value as at the grant date is used to arrive at the employee benefit expenses. Okay, so employee is providing services, you are giving them an ESOP. So there is a barter. You are receiving services, in return you are giving them your own shares. Now I cannot arrive at a monetary value of the employee's services, so to speak, but I can arrive at a fair value of the shares which I am giving. So the standard says you will do best to recognize the fair value of the services. You will do best to recognize the fair value of the ESOPs granted as at the grant date to be the employee benefit expenses that has to hit the P&L. Now, if these are in respect of shares or ESOPs which are already vested at the time of giving the ESOPs, it will hit the P&L immediately. If there is a vesting period, you have to remain in employment for 2 years, 3 years, 4 years, whatever it is, then the expenses will be apportioned over the vesting period on a straight line basis. So that is typically the manner in which you will do the accounting over the vesting period. Apart from that, you could also have certain vesting conditions, which could be performance. There could be certain performance related conditions. Service condition, you remain in employment. Performance condition divided into two types. Market linked performance condition, you do not do anything. It is included in the fair value. You do not do anything. Non-market linked, like for example, your turnover or EBITDA or GOP margin, whatever is the condition that is within the control of the entity, that in those cases, I will at the end of each reporting period in the vesting stage, I will estimate whether I am meeting or going to meet, and accordingly I will revise the estimate of my vesting period and do the accounting. Is it okay? Yes, after the vesting period, it will be an exercise of options. So when I do this accounting, the entry will be employee benefit expenses account debit to SBP reserve, to share-based payment reserve. Are we okay with the Ind AS 102 treatment? Yes. Are we okay, Rashmi? Yes, all right. Now, under accounting standard, do we have a standard or is it pursuant to a guidance note? It is pursuant to a guidance note. And what does that guidance note specify? The guidance note specifies that at the grant date, you will do the accounting based on intrinsic value. You will do the grant date based on intrinsic value. What is intrinsic value? The difference between the market price as on the date of granting of option versus the exercise price that is given. That differential is known as the intrinsic value. Intrinsic value is a measure at that particular point in time. It does not talk about a future estimate. That means my market value, let us suppose it is 100 and exercise price is 60 at that point of time, then intrinsic value is 40. That's it. No future impact. But when I talk about fair value, there are a lot of variables which are captured. It peeps into the future. And that is why your fair value becomes a better measure scientifically. And that is why Ind AS says take the fair value. Do not consider the intrinsic value. Largely, everything else is the same in accounting. Okay, it is just the basis of measure that is different. Are we comfortable with the two treatments now? Yes. Are we comfortable with the two treatments, Rashmi? Yes. All right. Now, this will be easy for us to understand. Now, we move on to three cases in ESOP. Only these three cases will be there. There won't be a fourth. Okay, first case. Date of transition 1st April 2022. Okay, this is not going to change. It is the same across all the three cases. Now, case 1, the grant date is 1st April 15. That is also the same across all the three cases. Now, we look at the individual cases. Okay. In the first scenario, vesting period is 3 years, exercise period is 1 year. Okay. When did I grant the option? 1st April 2015. What is the vesting period? 3 years. That means 15-16, 16-17, 17-18. That means by 31st March 2018, would the options have been vested in the employees? Yes or no? Yes? All right. Now, after 31st March 18, exercise of 1 year. So by 31st March 2019, can I say options would have been exercised? Yes. All right. If there is unexercised options, if there are any unexercised options, that would go to your retained earnings under guidance note also. So by 31st March 2019, is there any trace of this ESOP plan in the financial statements? Is there any trace, or can I say that the ESOP plan is over and out? Can I say that it is over? Yes, by 31st March 19, vesting हो गया, exercise हो गया, then what is left? Yes or no? Did you follow? By 31st March 19, by 31st March 19, yes, over and out. There is no ESOP plan existing in case 1 on the date of transition. Yes or no? Bolo, yes? All right. So did you understand case 1 properly? Yes? All right. Why I'm asking is, you only will tell me what will be the transition impact. I will not tell anything. You only will tell me the transition impact. Okay. Second scenario. Date of transition 1st April 22. Grant date 1st April 15. Vesting period 5 years. Exercise period 5 years. So tell me, in this case, when is the vesting period ending? When is the vesting period ending? Yes. 2019-20. Absolutely. So 15-16, 16-17, 17-18, 18-19, 19-20. 19-20, your vesting is over. After that, you have 5 years to exercise. So when is the exercise period ending? 24-25. So in this case, is the ESOP plan complete in all respects, or something is still pending as on the date of transition? And what is pending as on the date of transition? What is pending on the date of transition? Yes, exercise period is ongoing. Exercise period is ongoing. You have completed the vesting, no doubt about it. Vesting is over. That means which part is over? In vesting period, what are the journal entries that you pass? There is only one journal entry that you pass. Employee benefit expense account debit to SBP reserve. And if it was your guidance note, you would typically pass the entry employee benefit expense to stock options outstanding account. Yes or no? But apart from this, anything else you would pass? यही entry होगा. So can I say that in the second case, employee benefit expenses are completely recognized because the vesting period is over. Can I say this? Can I say this? Understand the question again. I am asking, can I say that in the second case, the employee benefit expenses are fully recognized by the date of transition? I'm not talking about exercise. I'm only talking about the vesting period. Vesting period, you have said it ends in 2019-20, which is correct. That means 2015-16, you would have passed the entry employee benefit expense to stock option outstanding. In the second year, you would have passed employee benefit expense to stock option outstanding. Third year, same entry. Fourth year, same entry. Fifth year, same entry. Will you pass this entry in the sixth year in 2020-21? Answer is no, because your vesting period is over. So can I say that all my expenses are booked in the second case? Only exercise is pending? Yes, you have agreed to that. So in the first case, now understand carefully. In the first case, can I say that SBP reserve, or what you call as stock option outstanding account, has become nil because the option is completely over from all respects? Can I say this? Can I say this? Yes or no? First case. Okay. Second case, can I say that SBP reserve or stock option outstanding, can I say it is nil? Can I say it is nil, or will there be some balance? Exercise period is still left. Okay, so balance will be there. Yes, so this cannot be nil. There will be some balance, whatever it is. Okay, there will be some balance. Coming to the third case. Okay, coming to the third case. Now, the third case, on the date of transition, 1st April 22, grant date 1st April 15, vesting period 10 years, exercise period 4 years. What is the third case? Tell me. What is, in terms of vesting period, exercise period, in the third scenario, which period is over, which period is pending? Yes. Yes. Tell me. Which period? Exercise is pending is fine. Is the vesting period pending, or vesting is also over? Yes. So vesting is also pending on the date of transition. Obviously, exercise will be pending because exercise will come after vesting is over now. अगर मेरा vesting हो गया, then exercise will come. Here, vesting only has not reached completion. So exercise is not going to happen till then, right? So both are pending. So can I say that? Can I say that in the third case, SBP reserve, or what you call as stock option outstanding, can I say that it still has some balance? Yes. And can I say that this balance can increase? Yes. Can I say that this balance can increase? I'm not saying it will. I'm saying it can. Okay. Now, Now recollect what I told you. Under the guidance note, how were ESOPs accounted? Using which value? Intrinsic value or fair value? Which value was used? Which value was used? Under the guidance note, not under Ind AS. Under guidance note, we were using intrinsic value. We were using intrinsic value. Fair enough. Fair enough. Now, in these three cases, the first case, will it have any impact on the date of transition? Under Ind AS, I have to use fair value. Yes or no? Because Ind AS 102 requires you to measure it at fair value. In the first scenario, I'm talking about this. You have told me that stock option outstanding balance is 0. So, as on the date of transition, is there anything open in respect of the first ESOP plan? No. That means, will this ESOP plan be a subject matter of contention for transition? No. Absolutely right. No. You do not have the requirement of booking employee benefit expense. You do not have the requirement of exercising, because SBP, the share-based payment plan, is over, complete, fulfilled. There is no outstanding account balance also left. So first instance, there is absolutely no requirement of uh, there is absolutely no requirement of transition, because as on transition date, that stock option plan itself does not exist. Okay, it is completed. Okay, so that is the first case. Second case, what have you said? You said that there will be some balance in stock option outstanding account. Yes or no? Yes. This would be at which value? You are moving from guidance note. Under guidance note, this would be at fair value or intrinsic value? The balance here would be fair value or intrinsic value? I'm again saying, under the earlier guidance note regime, this amount which is appearing in your financial statements before transition, would it be at fair value or would it be at intrinsic value? I'm talking before. Yes, it would be at intrinsic value. But Ind AS requires it at what value? For Ind AS, you need it at fair value. Agreed? So can I say that in the second case, I have come to a fork? I have a fork now. I was following a guidance note, and the guidance note permitted intrinsic value. Now I have reached a junction. Now I can continue intrinsic. I have two values in front of me, two options. Intrinsic value pe hi rahu, or should I move to fair value? What do you think? What do you think should be the accounting treatment? Should I change this to fair value or should I keep intrinsic value? Think logically. I'm not asking about the standard. I'm just asking, should it be fair value? Should it be intrinsic value? On the date of transition, this fork is the date of transition. It should be fair value. It should be fair value. Yes. If Ind AS 101 was not there, you would mandatorily require to restate this to fair value. Now understand the sequence of events. Understand the sequence of events. Can I say that in the second case, my employee benefit expense is totally booked before the date of transition? Can I say that my employee benefit expense is entirely booked before the date of transition? Can I say that? Are no, nahi. Yes or no? Yes. Why do you say so? Which period is over? Look at this. Can I say that vesting period is over? Yes. Can I say this? Vesting period is over. Vesting period is over means employee benefit expense is entirely booked. Yes or no? Yes. There is a overwhelming evidence that this employee benefit expense is booked at intrinsic value. There are no two doubts about it. This is booked at intrinsic value. The Ind AS regime requires it to be at fair value. But this is where, and I repeat, this is where Ind AS 101 steps in and says, your employee benefit expenses are fully booked. Your employee benefit expenses are fully booked. That means the P&L has already absorbed the hit of the employee benefit expense before the date of transition. That means the P&L has absorbed the employee benefit expenses before the date of transition. On and after the date of transition, there is no P&L impact that will hit in respect of this ESOP plan. Are you able to understand? Yes? Are you able to understand this? Yes or no? Bolo? So if there is no P&L impact henceforth in exercise period, what is the only entry that you will pass? There will be only two entries which you will pass. The first entry will be bank account debit to SBP reserve because employee will pay, and then you will move the SBP reserve to equity share capital securities premium. यही दो entry pass होगा. You will only have these two entries in the exercise period. Now tell me, in these two entries, is there a P&L impact or it is only a balance sheet to balance sheet impact? Tell me, is there a P&L impact or is there a balance sheet to balance sheet impact? What do you say? Only a balance sheet impact. P&L will not be affected. P&L will not be affected. So Ind AS 101 steps in at this point of time and says, now you have the option. I am giving you the option to continue the intrinsic value account, to continue the intrinsic value of the SBP reserve, which is sitting in the balance sheet. Are you able to follow? Yes, you have your SBP reserve sitting in the balance sheet at intrinsic value. All vesting is over in respect of this plan. Now only exercise is pending. So Ind AS 101 says that I know that this is a wrong measurement. It should have been at fair value, but it is at intrinsic value. In spite of that, I am giving you an exemption because all the impact that had to go to the P&L has already gone. Now you need not revisit that impact again because the contractual vesting period is over. तो जो भी value आपके balance sheet में है, whatever value is appearing in your balance sheet, you can continue to treat that as the value on the date of transition for the purposes of Ind AS. इसको थोड़ा सा sophisticated language, in technical language as an accountant, if I have to put, Ind AS 101 gives you the option to adopt the previous gap carrying value in respect of the SBP reserve where the vesting period is over as on the date of transition. Are you able to follow case 2? Yes. Are you able to follow case 2? Yes. Now the scenario is, sir, option hai ki mandatory hai? It is optional. It is optional. If you want to take the effort of calculating the fair value on the grant date. Matlab, you are transitioning on 1st April 22, date of transition. That means you will be preparing most likely 1st April 22 means 23-24 would be the first year of Ind AS financial statements. Right? So 23-24, sorry, not 22-23. Yeah, 22-23 would be the comparative period. 23-24 would be the first year. 1st April 22 would be the date of transition. That means when you are in 2023-24, if you want to do fair value, you will have to go back 9 years in time. You will have to go back 9 years in time. You are on 2023-24 when Ind AS has become applicable to this company. So if you have that much of an itch to follow fair valuation 100%, then go back in time to 1st April 2015. Imagine or rather reconstruct what is the growth of the company, what are the metrics required for a binomial model, what were the metrics that are required for a Black and Scholes model, what were the dividend rates that you estimated, what were the growth rates that you estimated at that point of time. All these things you go back in time, imagine and calculate the fair value as on 1st April 2015. Bring that to the current year because you never restate the SBP reserve balance because it's an equity balance. Compare it with your intrinsic value. So your intrinsic value, assuming it is 40 and fair value, assuming it is 60, you will pass one entry, retained earnings account debit to SBP reserve 20 rupees. क्या मिला ये करके? What did you get by doing this? You have increased the SBP reserve. You have moved it from one reserve to another reserve. Is it a meaningful adjustment that you are doing? Answer is no. But you still have the itch to do a full conversion? Go ahead, do it. But Ind AS 101 says, I know the practicality. It's not easy to go back 9 years in time and do all this kind of activity. So therefore, jo hua, so hua. Keep it as it is. Do not break your head. Are we okay with second plan? Yes. Are we okay with the second plan? Yes. All right. Perfect. Now, third में मेरे को बताओ. Tell me in the third plan, what is happening? What is happening? You can unmute yourself and speak so that we can proceed faster if you are comfortable. Yes. What is happening in the third plan? Third plan में vesting period. Oh, I have to unmute you. Okay. Just check.
Hi, sir.
Hello. Yeah. So in the third plan, what is happening?
Excise date is still pending.
Okay.
Vesting is also pending.
Yes. So if vesting is also pending, then it means that even after transition date, there will be some expenses that will hit the P&L.
Yes, sir.
Yes. That means after you move to Ind AS, you will still have employee benefit expense getting recorded. Yes or no?
Yes.
So therefore, to keep in line with Ind AS requirements, should there be a transition relief in the third case like how it was there for the second case? Think about it. Second case permitted you to keep the SBP reserve at intrinsic value. No need of restatement. But in the third case, you still have expenses to be booked. You still have expenses to be booked. Can I keep intrinsic or should I move to fair value?
I think we can
we should,
Yes,
okay,
it should be
we should move to fair
fair
value,
value.
because otherwise what will happen under Ind AS, I would be booking an employee benefit at intrinsic value, which is not permitted under Ind AS. Yes or
Yes,
no?
yes, sir.
So therefore, in the third case, no relief is present. No transition relief is present. You have to mandatorily find out the fair value and do the accounting using the fair value for the balance period after transition. Are we okay? So
Yes,
you will go back in time, put the effort to calculate the fair value and calculate the fair value. Are you okay with this?
yes, sir.
Yes. So that takes care of your fair value, I mean your ESOP, as one of the mandatory guidance. Okay.
Yes,
So we move to one question is there here. Uh, okay. X Limited is a first time adopter of Ind AS. The date of transition is 1st April 20X1. It has given 200 options to its employees. Out of these, 75 options have vested on 30th November 20X0. Remaining will vest on 30th November 20X1. That means I have two categories: 75 options
yes,
vested
sir.
before transition date, 125 options will vest after the transition
Transition.
date. So what are the options available to X Limited at the date of transition? For 75 options, what are the choices that you have?
Mm, mm.
Can I say this 75 options is nothing but case 2 in our example?
It's as per 102.
No, 75 options, when have they vested?
November 30th.
November 2020.
Yes,
That means, can I say they have vested before the transition date?
yes, sir.
So exercise period, it's not talking about anything. So we'll assume exercise is pending. Okay, so now can I say that this falls under category 2?
Yes, sir.
So what options do I have? I can take the previous gap value for SBP reserve. Yes.
Yes. Mentions.
Yes or no?
Yes, sir.
Or I can do a fair valuation.
Yes.
And second case, remaining 125 will vest after the transition date. Yes.
Yes, sir.
So here, do I have a transition relief?
Yes.
No, no, because you have to book an employee benefit expense for April to November. Yes or no?
Yes, sir.
So this has to happen at fair value. This cannot happen at intrinsic value. Yes or no?
Yes, yes.
So here you have to follow fair value. Are you able to understand? So 75 options which have vested on the date of transition. You can either do the previous gap or you can opt for fair value. 125 unvested, only fair value. Is it okay?
Yes, sir.
Did you understand?
Yes, sir.
Sure? Okay.
Yes.
So I'll share this PDF with you. Don't worry. Okay.
Yes. Okay, sir.
I'll share this PDF because this is a revision class, so I do not have the time to make you write
Right.
it down. Okay, but I'll give this PDF to you. Okay, all
Okay.
right. So that is about ESOPs. First step, ESOPs. Okay, very important adjustment and interesting also. Okay,
Okay.
basically, when we talk about transition, you have to look at those items which were there in the AS regime as a closing balance and how it will be treated under Ind AS 101. Okay, so that is the basic thing that you will have to keep in mind. Okay,
Okay.
because only that can affect. P&L is already gone in your reserves and surplus, so there I don't have to do anything. Okay,
Yes,
so
sir.
it's all about your balance sheet items where the criticality arises. Okay, now foreign exchange. Foreign exchange. Okay, you have studied AS11, right? You may
Yes.
not remember it right now, is a different matter, but you have studied AS11. Okay, now AS11 dealt with foreign exchange gain or foreign exchange loss. Yes,
Okay.
effects of changes in foreign currency rates. Yes or no?
Yes, sir.
Now, under that AS11, there were two paragraphs, paragraph 46 and paragraph 46A. Paragraph 46 and 46A, these two paragraphs came into existence in 2011. Okay, I remember this because this was the time when we were students answering our CA final. Okay, so what had happened in 2011, rates fluctuated very violently. It fluctuated very violently. Okay,
Okay.
rupee was performing very bad. So you had a lot of companies which had taken foreign currency borrowings. Okay. They took foreign currency borrowings because the rate of interest is very low on foreign currency borrowings. Like today, if you take a loan from a bank in the United Arab Emirates, your rate of interest will be between 5 to 6, maximum 6.5. Because there you're it's about parity. It's about India, our currency is lower, inflation is higher, so rate of interest will be higher. Outside, we have a stronger currency, lower inflation, lower interest rates. So entities, what they would do was they would take foreign currency borrowings. Now, tell me one thing. Is a foreign currency loan a monetary item
Yes,
under
sir.
AS11? Yes.
Yes.
That means if it is a monetary item, can I say that you will have to restate the closing rate?
Yes, sir.
Yes. Okay. Now imagine, go back to 2011. You have a foreign currency loan and suddenly your exchange rates dipped by 20%. I don't know the exact number. I'm just making this up. It dipped by 20%. What will happen? What will happen? when you when the year started, the rupee dollar exchange rate was, let us assume, 60 rupees per dollar. By 31st March 2011,
Mm.
it became 72 rupees.
Mm.
It became 72 rupees.
Mm.
60 became 72. There is
Yes.
a difference of 12 rupees.
Yes, sir.
What entry you will post? Foreign exchange loss account
Exchange.
debit
That's
to
exchange.
foreign currency borrowing.
Alright.
Yes or no?
Yes, sir.
Correct?
Yes.
So can I say that this is for $1, 12 rupees? Let us suppose you have borrowed $1 million. That means 10 lakh dollars.
Mm.
So 10 lakh into 12, that means 1.2 crore will be a sudden hit in your P&L.
Yes, sir.
Okay.
Mm.
This was a problem that a lot of corporates faced at that point of time. So they went to the Ministry of Corporate Affairs with an application saying that protect my P&L from volatility. This is not my mistake that my currencies are fluctuating so badly. Please protect us from volatility. So the Ministry of Corporate Affairs said, fine, we will help you out this one time only. And it gave a second option. The first option is taking the foreign exchange gain or loss to the P&L. This option was always there. Initially, before para 46A, सिर्फ यही choice था. You had to take the hit to the P&L. But looking at the volatility, the Ministry of Corporate Affairs said, fine, we give you a one-time irrevocable choice. Which choice? Irrevocable. Matlab in future, you cannot come back only. And that irrevocable choice becomes my option 2 under para 46A. Okay. Now, what does para 46A tell? Para 46A tells us that if you have taken a general loan, not for any asset, not for any asset acquisition or asset construction, if you have taken a general loan, say a working capital facility, okay, now the currency fluctuation, you would have passed the entry P&L account. Sorry, 1 second. You would have passed the entry Forex loss debit to external commercial borrowing. Yes or no? Correct? You would have passed this entry. What the Ministry of Corporate Affairs said is, fine. Okay, and by the by, this would go to the P&L. So the Ministry of Corporate Affairs said, okay, we are sympathetic with you. We understand your pain and we understand that we are part of your pain. So what we will do is we will give you an option. You will not take this hit to the P&L immediately. Instead, we allow you to park it in foreign currency monetary item translation difference account debit. Instead of P&L hit suddenly, you can park it in FCMI TDA account. You can park it in FCMI TDA account, and ultimately this FCMI TDA account will hit the P&L over the life of the loan. Over the life of the loan, it will be taken to the P&L over the tenure of the loan. Are you able to understand this? Yes. Did you understand the option? FCMI TDA is a balance sheet account. The balance sheet account permits you to take the impact of the huge foreign loss that came because of volatile exchange rates over the tenure of the loan on a smoothened basis, which was acceptable to the corporates. Is it okay? Yes. Now, where I had taken the loan for the purchase of a depreciable asset, where I had taken this loan for purchase or acquisition or construction of a depreciable asset, instead of FCMI TDA, I would capitalize the exchange loss. So FCMI TDA ke badle, you would have taken the impact to your asset. You would capitalize it. So it would be property, plant and equipment account debit to external commercial borrowings. And then that greater amount you would depreciate. Did you understand this? Yes. Did you understand both the options? Okay. Please remember, 46A was an option. 46 para was, the principle that was originally there was you had to take the exchange gains or losses to the P&L. This was a one-time relief that was given to the companies. Are we okay with the scenario under AS11 regime now? Yes. Yes. Okay. Now comes the interval के बाद वाला scene, which is basically your Ind AS. Okay, which is basically your Ind AS. Now, you have studied Ind AS 21. Tell me, In Ind AS 21, do we have a para similar to para 46A? Similar to para 46A, do we have a para? Yes. No. We do not have a para in Ind AS 21 that permits capitalization of exchange gains or losses. We do not have a para that permits movement of exchange gains or losses to FCMI TDA. That para is not there in Ind AS 21. In Ind AS 21, you have to take all exchange gains or losses, no matter how huge it is, to the P&L. Are you able to understand? Yes? Yes or no? So, AS11 permitted you to take the exchange gains or losses to the balance sheet either through FCMI TDA or through depreciable asset and amortize or depreciate it over the future, either tenure of the loan or life of the asset. Smoothen it out. In days 21, whatever happens, doesn't matter if your exchange rate goes to bonkers, doesn't matter. You have to hit it to the P&L. This now, both of these are meeting on the date of transition. Are meeting on the date of transition. Can I say that there is a conflict on the date of transition? Can I say that there is a conflict on the date of transition? Yes. Now, when there is a conflict on the date of transition, Ind AS 101 had to come up with guidance. Okay. This becomes what is the conflict? Now understand carefully. See, this choice was irrevocable. This choice was irrevocable. Who gave this choice? Ministry of Corporate Affairs gave this choice by amending the accounting standard. Who brought in the Ind AS? The Ministry of Corporate Affairs only brought the Ind AS. So Ind AS 10-15 years before they gave, not 10-15, around 4-5 years in 2011, before Ind AS became operational, they gave this option. Within 4 to 5, they said it is irrevocable. Matlab, as long as your asset and loan continue to exist, you can never go back to treat it as taking it to the P&L. Nahi. But IFRS came, India converged, Ind AS came. Now, MCA is facing a conflict that it had only created by giving an irrevocable choice earlier and now by bringing Ind AS. So therefore, in the MCA had to come up with some clarification. And this clarification, they brought it out by way of a carve out to IAS 21, by way of a carve out to IAS 21. This carve out is not there in Ind AS. This carve out is not there in the IFRS standards. It is exclusively to Ind AS because that para 46A also is exclusive to Indian companies. So this came out as a carve out. Now, what does the carve out tell us? What does the carve out tell us? Okay. Understand carefully. Okay. Now, let us suppose I had an existing loan. I had an existing loan. In respect of this existing loan, I had availed FCMI TDA option. That means option 2. I opted for the deferral. What MCA told me in the carve out is, if you had availed option 2 earlier, then you can continue to accumulate the gain or loss even after transition in FCMI TDA account. That means effectively it has permitted you to carry forward the FCMI TDA adjustment into the current regime as well. Are you able to understand? Yes?
Yes.
Restatement should happen. Your foreign currency liability should be restated at the closing rate. The only thing is the movement instead of taking to the P&L as mandated by Ind AS 21 can be taken to FCMI TDA by virtue of a carve out that is given under the Ind AS regime. Are we okay with this?
Yes, sir.
Yes. Now, understand further. Understand further. Forex gain or loss. Now I'm giving you the overall understand. Okay.
Mm.
Suppose Forex gain or loss under AS regime, I had opted for option one. Option one, what it was? What was option one?
FCMITD.
Taking it
Sorry,
to the
PNL.
P&L.
Yes.
So I was following this only. That means taking it to the P&L. Okay. So you were doing this until the date of transition. Then date of transition happened. So now, can I go for FCMI TDA under the Ind AS regime? Logically, you think yes.
Sir, actually, this is option one, no, sir.
Yes.
So
Option one,
we can
I
take
did
the
not
PNL.
avail the benefit that MCA extended at that point of time. I said, who will do all that FCMI, TDA and asset? I will keep my asset and balance sheet balances clean. Whatever is your exchange loss, I will take it and hit it to the P&L. Okay.
Okay.
In 2011. Okay. That loan continues till now on the date of transition. So now you tell me, logically, I had already taken the hit in the P&L earlier, correct?
Yes.
Date of transition happened. Now,
Yes.
Ind AS 21 gives a carve out if you had taken the difference to FCMI TDA or asset account. Yes or no?
Yes, sir.
But here, had I availed that option? Answer is no. You had taken it to the P&L. So does it really make sense for you now to move it to FCMI TDA account? Whatever losses you henceforth incur on account of exchange fluctuation? Yes.
Yes.
Does it make sense?
No, sir. No, does not make
No.
sense.
So that is why if I was following option one earlier, I will have to mandatorily take the exchange loss under the Ind AS regime mandatorily into the P&L. I cannot avail the benefit. Did you understand?
Yes, sir.
Yes. A new loan, you will take it to P&L only. A new loan means new loan taken after the date of transition. Okay. So existing loan, you did not avail para 46A. You took the difference to the P&L, exchange fluctuation to the P&L. You will continue to take the exchange difference to the P&L even after transition. Is it okay?
Yes, sir.
Now, let us suppose you had availed the benefit of para 46A for an existing loan. For an existing loan. Now, I have two options available. The first option is what? The first option is if I have taken the loan before transition and I had availed FCMI TDA or fixed asset capitalization option, then I have two options available. First option, follow the treatment that was taken in the previous gap, that is capitalization of forex losses or moving it to FCMI TDA. So option 2 I availed, I can continue that same option under Ind AS regime also in respect of the loan taken before transition. Did you understand?
Yes, sir.
और सेकेंड ऑप्शन इज मैंने उस टाइम पे अवेल किया था para 46A. I availed it that time, but on transition date, transition can be taken to be, it is a fantastic opportunity for companies to clean up their past sins. Okay. I
Yes.
always tell that transition is like a birth of the company's balance sheet, not the company. Company's birth happens at incorporation. Your transition to Ind AS is a fantastic opportunity to clear up all your past sins. Okay. And
Yes.
start with a clean slate. It is as if, holy waters of the Ganges falls upon the company and you become clean after the transition. Yes, to make new sins again. Okay. So this is a fantastic opportunity. So now I was following the option of FCMI TDA, but Ind AS tells you can always come back and take it to the P&L. So balance tenure, whatever is the exchange gain or loss, you will take it to the P&L. You will take it to the P&L. So option 2 में था, I can continue option 2 or I can continue or I can move to option 1. Are we able to understand?
Yes, sir.
Now, if I have taken a new loan after the transition date, it is mandatorily under the P&L. No FCMI TDA option. No FCMI TDA option. Are we okay with this?
Yes, sir.
Yes. So to put in simple terms, previous gap, I was following option 1. That means taking the exchange differences to the P&L. In Ind AS, can I continue in option 1? Answer is yes, allowed on date of transition. Suppose I was operating for option 1, that means taking the difference to the P&L under AS11. In Ind AS, I want to opt for option 2. मैं पहले I was washing everything in the P&L. Current year, I got this itch to take it to FCMI TDA. Ind AS says no, 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 no. We can allow continuation of old sins. We will allow cleaning up of old sins, but we will not allow creating new sins. हम नए पाप allow नहीं करेंगे. So therefore, if you were following something correct earlier, correct, I'm putting in quotes because it's not about correct or incorrect. It's about something that was already in line with Ind AS. Then after transition, you cannot avail option 2. It is not allowed. Previous gap, I was doing an activity that was as per para 46A. So to speak, colloquially, informally, I was doing something that was not the usual treatment.
Mm.
Can I continue with the same treatment? Answer is yes, in respect of existing loan. This is the relief that is provided by Ind AS 101. Are you able to follow?
Yes, sir.
And Ind AS is so magnanimous that it says if you have committed a sin in the past and you want to amend your ways in the future, you are most graciously permitted to do that. So option 2 you were following, you came on to option 1. Can you do that? Answer is yes. Doing the right thing is always allowed. So therefore, permitted. Did you understand?
Yes, sir.
Yes.
Yes,
Second
sir.
scenario, all clear?
Yes, sir.
Yes, all right. Then, in respect of foreign currency only, there is another concept called FCTR, which was there under AS11, Foreign Currency Translation Reserve. Your foreign currency translation reserve was a reserve that was created for non-integral operations. For non-integral operations. Non-integral operations in a foreign country, you used to convert that trial balance into rupees using the conversion principles under AS11. Whatever was the difference, you would take it to FCTR. Whatever was the difference, you would take it to FCTR. So
Mm.
your existing FCTR balance, if it is there on the date of transition, that would be by virtue of the requirements under AS11. Are you okay with this?
Yes, sir.
Now, under Ind AS 21, we have foreign currency, we have presentation currency, and we have a functional currency. Yes or no?
Yes, sir.
There is a functional currency. Functional currency wala option was not there in your AS11. It was not there in AS11. So you have two options. You have two options. You can either recalculate your FCTR as per Ind AS 21 requirements. Matlab you take the entire trial balance of the old regime, take the impacts in the new regime, convert it, and then arrive at the FCTR. That is your first option. Or second option, don't fall into that heavy work. What will be the second option? Second option will be reset the FCTR to 0. Take previous gap carrying value is not allowed. Okay, previous gap carrying value was as per AS11 requirements. So again, understand the principle. Previous sins are not allowed in this particular case. Why? Because this is an ongoing activity. Okay, एक बार मैंने पाप किया तो करता रहूंगा. So therefore, the whole option is the whole objective is, in this case, either you recalculate the FCTR right from the beginning for a perfect convergence, or make the FCTR 0 and take it to retained earnings. Bas baat khatam. Did you understand this?
Okay.
Yes. Previous gap value not permitted. This reset to 0 on transition, this itself becomes your transition relief. Is it okay?
Yes, sir.
Yes. So that closes out your FCTR also. That closes out your FCTR also. All right. Next. We take up some questions. Are you able to understand?
Yes, sir.
Okay. All right. Y Limited is a first-time adopter of Ind AS. The date of transition is April 1. On April 1, 20X1, April 1, 20X5. On April 1, 20X1, that means before transition, it obtained a 7-year $1 lakh loan. It has been exercising the option provided in para 4646A of AS11 and amortizing the exchange differences over the balance period of the loan. That means which option it had availed?
Option 2.
Yes, it had opted for option 2. Okay.
Yes, sir.
On the date of transition, the company wants to continue the same accounting policy with regard to amortizing exchange differences. Is it permitted? Yes.
Yes, sir.
See,
Yes, sir.
it is permitted, no?
Yes.
I told you. See, I was following option 2. I want to continue option 2. Is it allowed? Yes. And this is the relief that Ind AS 101 gives you.
Yes.
Ordinarily, your confusion is correct because you will always think Ind AS 21 does not allow me this. Yes or no?
Yes, sir.
But this is not coming from Ind AS 21. This is coming from a transition relief. Yes?
Yes, sir.
So therefore, this is permitted. Your confusion stems from the fact that you have rightly understood Ind AS 21. This is a transition relief that is there. Is the company permitted to do so? Answer is yes,
Yes.
you can. Okay, next. Okay. Y Limited is a first-time adopter of Ind AS. Date of transition 1st April 20X1. On the date of transition, there is a long-term foreign currency monetary liability of 60 crores, $10 million at an exchange rate of $1 equals 60. The accumulated exchange difference on the date of transition is 0. Since Y Limited was following AS11 notified and has not exercised the option provided in para 4646A. Tell me, previous gap, which option?
AS11.
AS11. That means option 1 or option 2?
Option 1.
Option 1. Okay. Now, the company wants to now avail the option provided under 46A of
Option 2.
AS11 prospectively or retrospectively on the date of transition. So, it is asking, it wants to move from option 1 to option 2
2.
after transition. Is this allowed?
No, sir.
This is not allowed. So how should it account for the translation differences under Ind AS 101? Continue to hit the P&L. Yes?
Yes, sir.
Continue to hit the P&L. You cannot avail the option of taking it to FCMI TDA. So that is illustration 12 for you. Okay, next. Y Limited, this is third question. Y Limited is a first time adopter of Ind AS. The date of transition is April 1, 20x5. On April 1, 20x0, it obtained a 7-year US dollar 1 lakh loan. It was exercising the option provided in 4646A. That means it was doing option 1 or 2.
Option 2.
Yes. On the date of transition to Ind AS, Y Limited wants to discontinue the accounting policy as per previous GAAP and follow the requirements of Ind AS 21, whether it is permitted to do so.
Yes, sir.
Yes, you are always permitted to do the right thing. So from option 2, it wants to move to option 1, permitted. So what will happen? The FCMI TDA balance will go to retained earnings, because now you cannot hold FCMI TDA. Once you have elected the option of taking to the P&L, you cannot hold it to the FCMI TDA option. Yes or no?
Yes,
So
sir.
therefore move it to retained earnings, and henceforth जो भी fluctuation है, you will take it to the P&L. You will take it to the P&L. All right. So
Yes, sir.
that concludes our second topic, that is foreign currency. Okay.
Okay.
Then we move to the third one, property, plant and equipment. Now, property, plant and equipment, what is your transition impacts? Okay. See, you can go back in time and do the Ind AS applicability. You can go back in time and do the Ind AS applicability, or you can go for a deemed cost exemption. You can go for a deemed cost exemption. What is the deemed cost exemption? Deemed cost says that current carrying value will be your transition value. Is your previous gap value, you can take that. Are you able to follow?
The current carrying value will be the
What is there in your AS, your regular balances as on the date of transition?
Oh.
Yes, that means you follow AS10, right?
Yes, sir.
So AS10, whatever value you have disclosed, that only will move into Ind AS 16.
Okay.
That is one option. Or second option is you can do a fair valuation on the date of transition. Okay.
Okay.
Now the fair value on the date of transition is not a revaluation option permission, right? It does not mean I'm following revaluation model. It is a starting point for Ind AS implementation. Is it okay?
Yes, sir.
Yes. That will become the deemed cost. That will become the deemed cost. And then if you do a fair valuation, it means you have adopted the revaluation model. If you continue that deemed cost in the future, it means you are doing a cost model only. Did you understand?
Yes, sir.
Yes. So basically, I have for PPE, or intangible asset or investment property, whatever it is, okay, there are two options, always two options. Retrospectively follow Ind AS. Retrospectively follow Ind AS. This is always by default going to be there for everything. Okay,
Yes, sir.
always. Standard will say तुमको करना है तो who am I to stop you, right? If you
Yes.
want to do the hard work, why should we stop you? Yes or no?
Yes, sir.
Or there is a deemed cost. Deemed cost. Yes or no?
Yes, sir.
Now, this deemed cost could be either previous gap carrying value, that is your WDV, or fair value on date of transition. Are we able to follow?
Yes, sir.
Now, see, this is deemed cost. Okay. So this is not a regular revaluation model. So we'll just write here, not reval model, but starting point. Starting point for Ind AS. Are you able to follow?
Yes, sir.
Yes. So this is there for your Ind AS. Okay.
Yes,
Next. So that covers property, plant, equipment. Okay. Next. You need a break or we can continue?
yes, sir. I can continue, sir.
We can continue. Okay. Fine. Because now there are two important things which are left. That is two, three actually. Okay. Then rest are all simple. Okay. Copy, estimate. Yes. Okay. The next one is business combinations. The next one is business combinations. Okay.
Yes, sir.
Now, what is business combination? And do we have a comparable standard under AS regime? Do we have a comparative standard in AS regime? Tell me.
Yes, I think there is no business combination.
We don't really have a comparative standard, though amalgamation AS 14, consolidation AS 21, you have these two standards which are there under AS regime. Yes,
Yes, yes, sir.
but there is nothing that is remotely similar to Ind AS 103. Okay, let us understand with the help of an example. A Limited holds 1000 equity shares in B Limited. Okay,
Okay.
that is 100% holding. All right. Now, C is also holding 10,000 optionally convertible debentures since 2015. Okay.
Yes,
C is transitioning to Ind AS on 1st April 2022. The optionally convertible debentures can be converted at any time at the option of the holder. That means at the option of C. Do you understand?
yes, sir.
Conversion terms are favorable. That means the option to convert is in the money. It is favorable to C. Okay. Did you understand the case
Yes, sir.
under AS 21? Who will consolidate B? Who will consolidate B? A will consolidate B. Yes or no?
Yes, sir.
AS21. AS21 does not look at optionally convertible debentures. AS21 को सिर्फ एक बात समझ में आता है. It understands only one thing. As
Yes.
on 31st March, who is holding my share capital? Who is holding B's share capital?
A.
A. So A will say ये मेरा subsidiary है. I will consolidate. Yes.
Yes, sir.
C is crying in the corner. लेकिन मेरे पास 10,000 OCDS है. Optionally convertible debentures. A बोलेगा I don't know. You have not converted on the reporting date. It doesn't affect me. ये मेरा subsidiary है. I will consolidate. And AS21 says you are correct. Did you understand this?
Yes, sir.
Coming to Ind AS 103, read with Ind AS 110. Who is the de facto control? Who is having the de facto control over B? Control किसके पास है?
A. A.
Again, think and answer. Is A controlling or is C controlling? Let us suppose 10,000 OCDs are convertible into one equity share for one OCD. Yes.
Both are controlling, sir, because it is 50% more than 50% stake.
Who is having more than 50% stake?
A is having more than 50% stake in B.
Yes, but I will take you to Ind AS 103 and Ind AS 110. What is the definition of control under Ind AS 110? You can recollect.
More than 50%.
Under AS21, you are defining that. Under Ind AS 110, percentage of stakeholding doesn't matter at all. Okay?
Okay.
Under Ind AS 110, control is more a characteristic rather than a defined number. It is the power by the investor that it can exhibit over the investee and gives it a right to the variable returns from the investee. And it has a right, it has the ability to use that power to influence the variable returns. Did you understand?
Yes, sir.
What did I say? Three components, right?
Yes, sir.
C is having power over B first.
Yes, sir.
Second, right to variable returns generated by B. Yes?
Yes, sir.
Second. Third requirement, सिर्फ power and right is not enough. Ability to use the power to influence the returns. Do you understand?
Yes, sir.
Variable returns of B means profit. Yes.
Yes, sir.
So now understand the boardroom dynamics. There is a board meeting of B. There is a board meeting of B or a shareholders meeting of B. Okay.
Yes, sir.
A is also in the meeting. C is also in the meeting.
Mm.
Can there be any decision taken without the acceptance of C?
Mm.
Why do you say so?
Because C is also holding, like C is a subsidiary of B, no?
I'm not even coming to subsidiary or holding. I'm saying, why do you feel that no decision can be taken without C's concurrence? C is holding 10,000 optionally convertible debentures.
Yes, sir.
That means I take your point that today C does not have shares in B. Yes?
Yes.
A is only having 100% shareholding in B. But be careful. C is having 10,000 optionally convertible debentures. Convertible at whose option? Convertible at the option of the holder. Yes?
Yes.
When can it be converted? Anytime.
Anytime.
And currently the conversion terms are favorable. Yes?
Yes.
So look at the substance now. Let us assume one OCD gives you one equity share. Look at the substance. Don't you think C is holding 10,000 equity shares disguised as optionally convertible debentures? Yes.
Yes, sir.
Don't you think that C is holding 10,000 equity shares disguised as optionally convertible debentures?
Yes.
Yes or no?
Yes, sir.
And if C elects the option to convert, what will be the holding? A will hold 1,000 shares, C will hold 10,000 shares. Who becomes the holder? Who
C and
becomes the parent now?
B.
C becomes the parent over B, right?
In terms of share, holding of share.
Yes.
Okay.
C becomes the C will hold 10,000 shares of B,
Yeah.
right?
Yes, sir.
So total shares is 11,000. Out of that, C will be holding 10,000.
10,000.
Yes or no?
Yes, sir.
So almost 90-91% will be held by C over B.
Okay.
So what you have to look at in Ind AS 103 or Ind AS 110 is not the actual shareholding, but you have to look at even convertible instruments, potential shares, which have the ability to determine who the controlling shareholder really is. Did you understand?
Yes, sir.
Yes. So this is not there under accounting standard. AS 21 does not recognize this. AS 21 asks a simple question. On 31st March, who is holding the share capital of A? Sorry, who is holding the share capital of B? Answer is A.
Mm.
C is standing somewhere in the corner and saying, मेरे पास तो 10,000 optionally convertible debentures है. AS21 will ask, did you convert?
Mm.
C will say, no, sir, I did not convert. Then you stay in the corner. A, you consolidate B. This is how AS21 operates. Did you understand?
Yes, sir.
Ind AS 110, Ind AS 103, who decides the decisions with respect to B? A will say, I decide, I hold 100% shares. In the corner, C is sitting. He will just say, I will just convert my 10,000 OCDs to 10,000 equity shares. Uske baad, what will happen to you? Then A will say, no, then you are the owner. Yes or no?
Yes, sir.
So therefore, C is having a substantive advantage to convert its shareholding, its OCDs to shares. And therefore, under Ind AS 103 or 110, the right parent to consolidate B is C and not A. Did you understand?
Yes, sir.
Yes. So A under AS21, A will consolidate B. Under Ind AS 103, C should have consolidated B. Okay.
Mm.
So 1/4/2015, when the OCDs are given. 1/4/2022 is your date of transition. Okay. Now there is a relief. Okay. Now just imagine. Forget about relief. Sab bhul jao. Now let us suppose Ind AS became applicable to C. Okay.
Okay.
Forget transition and all. Bhul jao. Forget everything. Just assume C has to follow Ind AS. Can I say that C has to follow Ind AS for standalone purpose and consolidation also? Yes.
Yes, sir.
Ind AS will be total now. It cannot be I follow Ind AS for standalone. Consolidation I will prepare as per AS21. You cannot say that, na? Yes or no? So therefore, C has to follow consolidation for the purposes of standalone also and consolidated financials also. Now, if C has to follow the consolidation under Ind AS, it should consolidate B. Yes or no? Yes. Forget transition relief. I'm not coming there. Now understand. If C had to converge to Ind AS, it should consolidate B right from 1st April 2015 because that was the date when it had the control. Yes or no? See, OCD since 1st April 2015. Yes or no? So it had to consolidate right from 1st April 2015. That means it had to go back in time on 1st April 2015, determine the purchase consideration on 1st April 2015, calculate the fair value of assets, fair value of liabilities, determine the goodwill, calculate the NCI on 1st April 2015. Then every year you do a consolidation cycle. So 1st April 15 ko Ind AS 103 you apply. 31st March 16, 17, 18, 19, 20, 21, 22. 7 years you have to consolidate before coming to the opening balances for the 8th year of 22-23 and 9th year of 23-24. Are you able to understand? Yes, are you able to understand? अगर transition नहीं होता, if you did not have the transition benefits, this was the activity that you had to do. This was the activity that you had to do. Are we okay with this? Yes. Is it practical to do 7 consolidations for the purpose of transition? Is it practical? No. ये तो सिर्फ एक सब्सिडियरी है. सपोज सी इज हैविंग 10 such subsidiaries, then all accountants who are there in C Limited's payroll, they will leave the company and go. कितना बैलेंस शीट बनाएगा मैं? ट्रांजिशन का कर सकता हूं, बट यू आर सेइंग मी 7 बैलेंस शीट्स, 10 बैलेंस शीट्स. हाउ कैन वी डू? इट इज नॉट प्रैक्टिकल. And to address this issue, to address this practical challenge, Ind AS 101 has given a relief. Ind AS 101 has given a relief. Retrospective restatement can be done with effect from a particular company decided date. That means it can say that, okay, so this company only, which one? C and B. C Limited got 1st April 2015 as the date of what you can say, it got it as the date of acquisition of optionally convertible debentures. What C can say is, fine, I will consolidate with effect from uh, 31st March 2020, with effect from 31st March 2020. Are you able to follow? Yes, it is a date that is chosen. It is a date that is chosen randomly. It is a date that is chosen randomly. and they will do the accounting, acquisition accounting from 1st April 2020. They will do the accounting from 1st April 2020. That means April 2020, March 21, March 22, March 23, March 24. Are you able to follow? Yes, 5 years. Yes, 5 years. Okay. Now, it can choose a date, or the deemed date of acquisition will be the date of transition. The deemed date of acquisition will be the date of transition, and do the acquisition accounting from the date of transition. Are you able to understand now? Yes. Are you able to follow? Yes or no? Yes. So now see, suppose it had to take 1st April 2020 as its date, then 2020, 21 March, 22 March, 23 March, 24 March. 5 consoles. But suppose we avail the benefit uh, given by the standard. What is the other benefit that is given? You can take it from the uh, you can take the consolidation from the date of transition itself. In which case, 1st April 22 is the date of transition. So 22-23 becomes 1 year, 23-24 becomes the second year. And you will have a 1st April 22 ka balance sheet. So 3 balance sheets will be done. Does it simplify your work? Yes. Does it simplify your work if I take the deemed date of acquisition as date of transition? Yes. You have to do consolidation only for 2 years. Yes, only for 2 years. Is it okay? Is it okay? Yes. Have you understood?
Yes, sir.
Okay. The whole point is this. You are simplifying your efforts on consolidation. There is no need for you to go back in time and keep on doing all consolidation. Okay.
Okay.
All right. Fine. Now, yeah. So when we go back in time and do a consolidation, basically you go back in time to calculate the NCI. You go back in time to calculate
NCA.
uh, the goodwill. You go back in time to calculate the fair value. Yes.
Yes, sir.
So basically you have to do this activity, this humongous activity, if you do not avail the transitory benefit that is given by this Ind AS. Is it okay?
Yes, sir.
Yes. Transitory relief, Leah, and you assume date of transition to be deemed date of acquisition, then do the accounting from then. Yes.
Yes.
Nothing like that. Okay. So that is all about business combinations. That is the key thing about business combinations. Okay. Next. Okay. Okay. So that's it for business combinations. 1 second. Let us see some questions. Okay, fine. We'll do one thing. We'll take a quick 5 minute break. Okay.
Okay, sir. Yes,
The
sir.
business combination I have completed. After the break, we'll do a couple of small questions and then come to compound financial instruments. Okay, 5 minutes break. We'll
Okay.
resume at 9:20. Yes.
Okay, sir. Yes, sir.
Okay. Yeah. Yeah. Shall we proceed?
Yes, sir.
Yeah. All right. So coming to some small questions on this business combination part. So illustration. Okay. Ind AS requires allocation of losses to the NCI, which may ultimately lead to a debit balance in NCI, even if there is no contract with the NCI holders to contribute assets to the company to fund the losses. Whether this adjustment is required or permitted to be made retrospectively. Okay. Now, see, understand this question. First, what is the meaning of a debit balance in NCI? Okay. And why this question has been asked? You remember AS21, right? In AS21, what did we call our NCI as? Minority interest, right?
Correct. Yes, sir.
And where did I show minority interest in the balance sheet?
Reserves.
Not in reserves. This would come after shareholders' funds. This would come after shareholders' funds. Okay.
Yes, sir.
That means it was not treated as part of owners' funds at all under AS regime. Okay.
Okay.
It was treated as a liability. It was treated as a liability. And therefore, under your AS regime, if I recollect properly, minority interest could not have a negative balance. If you have a subsidiary that was making loss after loss after loss after loss, the minority interest would bear the loss until its value became zero. Okay.
Okay.
And then the remaining balances after it became zero, that would also be borne by the holding company. Okay.
Yes, sir.
Under Ind AS, where does NCI appear?
Yes.
Where this goes? This
Shareholder.
goes as part of shareholders' funds. Yes.
Yes, sir.
Because what is NCI? NCI is ultimately holding the capital. In my consolidated financial statements, I hold 60%, NCI holds balance 40% if 60-40 ratio is there, right?
Yes, sir.
So that is also a capital contributor the way I am. So NCI is a part of shareholders' funds under Ind AS, and NCI can have a debit balance for that reason. Yes.
Yes, sir.
Non-controlling interest can be shown as a negative under Ind AS even if there is no contract to contribute to the assets in the event of losses. Okay.
Okay.
You may say that, sir, NCI ne to pura paid up value, it has paid fully whatever is to be paid, right?
Yes, sir.
In spite of that, you can have a negative NCI. In spite of that, you can have a negative NCI. All right. Now, in this case, if there is no contract, whether uh, if there is no contract, whether this adjustment is required or permitted to be made retrospectively. What did I say? Ind AS 101 permits you to choose the date of restatement in the event of a business combination. Yes, it can be any date of your choice. It could be the actual date of acquisition, in which case you will go back in time and do a restatement. It can be any date after date of acquisition, in which case you will do a retrospective restatement from the date that you have chosen. Yes or no?
Yes, sir.
Or it can be date of transition. In which case it won't be a retrospective restatement, it will be the current period's transitional financial statements adjustment. Yes.
Yes, sir.
So the choice of a retrospective adjustment depends on what is the choice of restatement that the company has adopted. You understand?
Yes, sir.
So this is not a plain simple yes or no. It is permitted depending on what is the choice that you have opted for. If you want to restate the previous business combinations, then NCI also will have to be restated
Yes.
from the prior period. If you are opting not to restate previous business combinations, then NCI for the prior periods also will not be restated. Is it okay?
Yes, sir.
Yes, did you understand? All right. Next, we move on to the next one. Yes, fine. Okay. Look at this question. A had made certain investments in B Limited's convertible debt instruments. A has made investment in B. The conversion rights are substantive. That means it's favorable and would provide A with a control over B. A has evaluated that B would be treated as its subsidiary under Ind AS and hence would require consolidation in its Ind AS consolidated financial statements. B Limited was not considered as a subsidiary, joint venture, or associate under previous cap. How should B Limited be consolidated on transition to Ind AS? Assuming that A Limited has opted to avail the exemption from retrospective restatement of business combinations. Yes, so it has opted to avail the exemption. Yes or no?
Yes.
That means you are going to restate with effect from date of transition. Yes.
Yes, sir.
That means no prior period restatement, no NCI of prior period, only date
Date
of
of transition.
transition onwards, whatever is there, you will be recording. Okay.
Okay, sir.
Net assets of B will be taken over, goodwill will be calculated, NCI will be calculated, everything from the date of transition. Okay.
Okay.
Yes.
Yes, sir.
Done. Good. So that is done. Then the next one is okay. Understand this now. This is interesting. Okay. A Limited has a subsidiary B Limited. On first time adoption of Ind AS by B, Ind AS by B, okay,
Yes,
not
sir.
A. B Limited has adopted Ind AS the first time. It availed the optional exemption of not restating its past business combinations. Okay.
Yes, sir.
B Limited availed the exemption of not restating past business
Past business
combinations.
combination.
However, A Limited in its consol financial has decided to restate all the past business combination. Subsidiary said, I am moving to Ind AS. I will not restate. I will not restate my past combinations. Its parent company said, I will restate all my past business combination. Whether the amounts recorded by the subsidiary needs to be adjusted while preparing console financial statements of A, considering that A does not avail the business combination exception. Will the answer be B different if A adopts B, if A adopts Ind AS after B Limited? Yes, tell me. First one. B Limited is having subsidiaries C, D, and E. Just example. Okay.
Yes, sir.
So B is saying, I will not do a retrospective restatement. Okay.
Okay.
That means B wants to consolidate from date of transition. Okay.
Yes, sir.
But A Limited wants to restate all past business combinations.
Okay.
So question is, should B modify its financial statements to capture all past business combinations? What do you think?
So, um, mm, like subsidiary, I think it can continue with the decision.
No, no. See, always remember, in parent and subsidiary, what a parent does, subsidiary has to listen. This is not like my kid doesn't listen to me. So then parent adjusts, right?
Mm.
In our family, if kids don't listen to their parents, parents adjust. Your generation, my generation, we are all like that, right?
Mm.
Parents adjust, kids follow what they want to do. But in corporate life, it doesn't happen. Parent says, I want to restate. Child also should say, okay, as my father, mother are telling, I will also have to follow the same thing. B can do whatever it wants for itself. But when it gets consolidated with A, it has to change its financial statements. Okay?
Okay.
It has to follow what parent tells. Hierarchy is very, very formal and bureaucratic in corporate life. In homes, it is not. Okay?
Okay.
So, will the amounts recorded by subsidiary need to be adjusted? Answer is yes. It needs to be adjusted. Okay?
Yes, sir.
All right. Now, will the answer be different if A Limited adopts Ind AS after B Limited? Okay. Now, look at this. First, B Limited adopted Ind AS. Okay.
Okay.
B Limited opted for Ind AS. Now, there is only one exception when this is allowed. What is that exception? If A Limited acquires B Limited after B Limited has adopted Ind AS. Okay. So what has happened is B Limited was a group C, D, E. Okay. This was one group. This whole group migrated to Ind AS. After migration, A Limited acquired B Limited. And then A Limited adopted Ind AS. Did you understand this?
Yes, sir.
Yes. So in this particular case, B Limited need not adjust its values
Okay.
because here B Limited will say, you are not my biological mother and father. You have adopted me after I was born. Yes or no?
Yes, sir.
If you have adopted me after I was born, I come with my own features and my own characteristics. You have to accept me as it is. Yes.
Yes, sir.
If A Limited gave birth to B Limited, B has no option but to listen to A. But since A has adopted after B gained its own identity, its own existence, its own decisions, A has to follow what B has done. A will restate other business combinations but not related to B. Is it okay?
Okay.
Did you understand? All right, fine. So that takes care of business combinations. Okay, we now move to the next one, that is compound financial instruments. Okay,
Yes,
now
sir.
compound financial instruments, basically convertible debentures, right?
Yes, sir.
These are treated as a loan under Ind AS. You show it as a liability, don't have to do anything.
Okay.
Under Ind AS, you remember we do split accounting, debt component and equity component. Yes or no?
Yes, sir.
So that has to be done. Okay. Now let us take an example. Example is already there. You don't have to do anything. There is a convertible debenture having a face value of 1 lakh. Coupon rate is 7%. Market rate of similar non-convertible bond is 10%. The bond is optionally convertible, having a tenure of 5 years at the option of the holder. At the option of the holder. Previous gap, the entry that you had posted was bank account debit to convertible debentures 1 lakh rupees. Is it okay? Under AS, this is the entry that you would pass. Yes or no?
Yes.
AS
No.
mein what was the splitting and all? There was no split. This
Yes.
would go and sit in your liability, 1 lakh rupees.
Yes.
Okay.
Yes, sir.
Under Ind AS, now let us suppose date of transition is 2 years after the issue of bond. So bonds are issued 2 years after that you have transitioned to Ind AS. Now, what is the Ind AS entry that needs to be posted when the instrument was actually issued? I would first calculate fair value of liability. Yes or no?
Yes, sir.
That would be
Present value.
1 lakh into 7%. This is your interest outflow into 3.7908. That is the present value annuity factor at 10% for 5 years. Did you understand this?
Yes, sir.
Plus, you will redeem the principal. So 1 lakh into 0.6209, which is the discounting factor at 10% for 5 years. Correct?
Yes, sir.
So your liability value is 88,626 and not 1 lakh rupees. Okay.
Mm.
So on the date of issue, the entry would actually be bank account debit 1 lakh to equity to liability. Equity would be 11,374 balance. Is it okay?
Yes, sir.
This is on date of issue. I have to move towards transition. Transition happens 2 years later. Yes or no?
Yes, sir.
So therefore, I will prepare a amortization table for 2 years.
Mhm.
Opening 88,626, EIR 8863 at 10%, coupon 7,000, closing balance 90489. 90489 opening, EIR 9049, 7,000, 92,538. Did you understand this?
Yes, sir.
Yeah,
Yes, sir.
sure.
Yeah.
That means on the date of transition, your instrument should have a liability value of how much? 92,538.
538.
Yes or no?
Sir.
And equity value of 11,374. Yes or no?
Yes, sir.
So therefore, I have to remove this convertible debentures. So convertible debentures debit 1 lakh. Correct?
Yes, sir.
Credit liability component 92,538. Credit equity component 11,374. Did you understand this?
Yes, sir.
This entry doesn't match. So obviously the difference will go to retained earnings. Obviously the difference will go to retained earnings. Did you understand?
Yes, sir.
Question comes, why do I have this gap of 3912? Why this gap is there? See, what is the interest under Ind AS? 88639049. Correct?
Yes, sir.
So this comes to 17,912. Correct?
Yes, sir.
But under AS, you have actually charged an interest of only 40,000 rupees. Yes or no?
Yes, sir.
So therefore, 17,912 minus 14,000,
3,900.
3,912 is the extra interest that has gone under Ind AS. Correct?
Yes, sir.
So that is why you have that gap of 3,912 sitting in your retained earnings, which
Yes.
should have been the interest that you would have charged if Ind AS was applicable from the beginning. Is it okay?
Okay, sir.
Okay. Yeah. So what I want you to do is, there is one illustration 15. I want you to try this for homework. Okay.
Okay, sir.
Only thing is here there is a premium of 10% on redemption. Okay.
Okay.
You should get the answer. Okay. Now, next one is joint venture. Okay.
Okay.
So compound financial instruments is done. We then move on to investment in joint venture. Okay. You remember how to account for a joint venture under AS 27?
Sorry, sir. I don't know.
Yeah. AS 27 was a very much neglected topic. Okay.
Yes.
Sorry, I have a bad cold. Okay. AS 27 required joint ventures to be accounted for proportionately, proportionate consolidation. That means if I had 40% stake in a joint venture, I would account at the time of consolidation 40% of assets, I would do a line by line consolidation. 40% of liabilities, I would do a line by line consolidation. You remember how we do consolidation here?
Yes, sir.
In Ind AS, we add 100%, no?
Yes, yes.
Yes or no?
Yes, sir.
In joint venture, what would happen was whatever is my share, I would add it proportionately. Okay?
Okay.
And some goodwill also would be recorded. Okay?
Yes, sir.
Now, under Ind AS 28, under Ind AS 28, how do you account for a joint venture? Under Ind AS 28, you use equity method of accounting. Okay?
Yes, sir.
What is equity method of accounting? Equity method of accounting means in my consolidation, I have investment in joint venture appearing as an asset. Yes or no?
Yes, sir.
To that investment in joint venture, I will add the profit share that is there. That's it. I will not do a line by line consolidation. Is it okay?
Yes, sir.
Understood the difference? Under
Yes.
AS, line by line, I would add all assets and liabilities.
Yes.
Under Ind AS, investment would appear at cost plus whatever profit the joint venture is earning, that share of profit will be recorded here. Okay?
Yes, sir. Yes, sir.
And if the company, if the joint venture declares dividend, you tell me, will it be added to the investment or subtracted from the investment value?
Will be added.
See, you have added profit when the profits were earned. Now, when dividend is declared, how can you add it again? You can't add it again, no? It will be a reduction.
So we are giving dividend or we are getting
We
dividend?
are getting dividend. See, forget joint venture, forget this. Tell me one thing. Let us suppose you are a partner in a partnership firm. Okay?
Yes, sir.
You have capital invested in the partnership firm. Yes.
Yes, sir.
Now that partnership firm makes a profit.
Yes.
That share of profit will be added to your capital.
Yes, sir.
Yes.
Yes.
And let us suppose you draw the money from the firm.
Okay. Yeah.
What will happen? It will reduce
Return.
from your
Yes,
total
sir.
capital, no?
Yes, sir. Yes. Correct.
This is also like that. I have invested in a joint venture, so invested amount is my capital.
Yes.
Profit from the joint venture gets added because that is my profit. Dividend is nothing but I'm drawing those profits.
Okay.
Yes,
Yes, sir.
dividend will be reduced. I get the dividend, but it will be reduced from the cost of investment under equity method of accounting in consolidated financials.
Okay.
Be careful, this is in consolidated financials. In standalone, dividend will go and sit as part of your income. Okay,
Yes, sir.
did you follow?
Yes, sir.
All right, so that takes care of your investment in joint venture. Okay.
Okay, sir.
All right, so there is one question. Basically it is, they have given what was accounted under AS and how you have to do under Ind AS. So basically you remove all assets. All assets which are consolidated are removed. All liabilities which are consolidated are removed. Balance goes to investment in the joint venture. That's it. Okay.
Okay.
Because these were all consolidated under AS 27. They are all sitting in the assets of the consolidated balance sheet, liabilities of the consolidated balance sheet. So from there, I have to remove them one by one. Okay.
Okay, sir.
So all assets will be credited, liabilities will be debited, differential goes to investments in ABC. So that is about joint ventures. Simple, but a little bit important. Okay.
Okay, sir.
Next. All right. Okay. We don't have time to do a lot of questions, but nonetheless. Okay. See, you have studied government grants, right?
Yes, sir.
In government grants, you would have studied government loans at below the market rates. Yes.
Yes, sir.
Now, what would you do in government loans? Okay. See, how would AS record that?
A loan will be recorded as liability only.
How it would record?
Be recorded as per um, accounting standard as
Yes.
liability.
As a
Liability.
yes. And would there be any split accounting?
No.
No. So let us suppose you have set up a unit in an industrially backward area and
Okay.
the government has given you 5 crore rupees loan
Yes.
at 1% interest.
Okay.
Ideally, the bank rate is 8%. You got it at 1%, right?
Yes, sir.
Under AS, how would I account for this? I would account a loan of 5 crore and every
Yes.
year I would accrue an interest of 1%. Correct?
Yes, sir.
You can continue the same thing under Ind AS also. This is the prospective application. You can treat it as a financial asset or liability at the previous gap value. At the previous gap value. Is it okay?
Yes, sir.
This option is available. So loan from government, continue to recognize the loan as a financial liability, or if you have taken it as equity as per previous gap value, Do not recognize a grant for the benefit arising due to below market rate of interest. No split accounting and all. Okay.
Okay.
This is the benefit that is given. If you do not want to do a benefit, if you do not want to enjoy the benefit, do the hard work, go for a retrospective restatement. What would you do for a retrospective restatement? You would go back in time when you actually received the loan, find out what would be the market rate of interest, and then calculate the fair value, take the differential as grant, and do the accounting. Do you understand?
Yes, sir.
Yes. So under Ind AS, for example, loan recognized at 10,000 under AS, a 10,000 rupee loan. This is the example. Loan of 10,000, market rate 10%, coupon rate is 2%, tenure is 5 years. In AS, I would recognize 10,000 and be at peace. Yes or no?
Yes, sir.
In Ind AS, I would take the loan 10,000 into 2% into 3.79 plus 10,000 into 0.621, 6,968 would be the fair value of the loan.
Yes, sir.
This loan, I would then pass bank account debit 10,000 to loan 6,968 to deferred government grant 3,032 rupees. And this deferred government grant, I would amortize it over my P&L over the life of the loan. Yes or no?
Yes, sir.
This is what you can do. Okay, so that is about government grants. Then we move on to accounting estimates. Accounting estimate क्या बोलता है? See, let us suppose your transition year is 2020 to 23. Okay,
Yes, sir.
date of transition would be 1st April 21. 22 23, 21 22 previous year, earliest of the previous year 1st April 21. On 31st March 21, you had made an estimate of 2 lakh rupees would be your bad debts. Okay.
Okay.
When you did 31st March 21, you thought bad debts would be 2 lakhs and you made a provision for 2 lakhs. But the actual bad debt in 21-22 is 3,50,000. Is 3,50,000. The transition year is 22-23. So tell me one thing, when I am transitioning to Ind AS, can I see this estimate of 2 lakhs?
No, sir.
Can I see this estimate of 2 lakhs?
Yeah.
First, can I see that the actual bad debt is 3,50,000?
Yes, sir.
Yes. So just look at the situation now. See, on 1st April 21, your provision for doubtful debts was 2 lakhs, correct?
Yes, sir.
You are in 22-23. Be careful. You are in 22-23. You have a visibility that you made a provision for 2 lakhs. But you also have additional information which has now come saying that actual bad debt in 21-22 is 3.5 lakhs. Okay.
Yes, sir.
That means your provision was short by 1.5 lakh, correct?
Yes, sir.
Now, where would this 1.5 lakh have gone? Forget Ind AS 101, everything. You have made a provision of 2 lakhs. Your actual bad debt is 3.5 lakh. How would the accounting flow? Simple words, don't get technical. Out of 3.5 lakh, you would meet 2 lakh against the provision.
Yes, sir. 1,50,000 is excess actually.
And that would hit the P&L in 21-22.
Yes.
Correct?
Yes, sir.
This is the normal thing that you would have done. Now, some people, they become over smart. Okay. वो क्या बोलेंगे? They will say, see, I am doing this particular activity in 22-23 and I realized that I have made a wrong estimate in 2021. When I prepared my balance sheet, I understated my provision by 1,50,000. Yes.
Yes, sir.
So when I'm preparing the opening balance sheet on 1st April 2021, I will make the provision itself 3,50,000 there instead of 2 lakhs. Do you understand?
Yes, sir.
So what they want to do is on 1st April 21, they want to pass an entry, retained earnings account debit to provision for doubtful
Yes,
debts, 1.5 lakhs. Do you understand?
yes, sir.
And in 21-22 P&L, you are now seeing currently a 1.5 lakh hit, right?
Yes, sir.
They will not show that hit because they are saying I have changed my provision in the opening itself. Do you understand?
Yes, sir. Yes. Right.
Yes.
Yes, sir.
Ind AS tells this is cheating. Yes, ये गलत बात है. I am giving you an opportunity to clean your sins doesn't mean you clean your sins to such an extent that you practically whitewash everything. That cannot happen, right?
Yes, sir.
On 31st March 21, you made an estimate of 2 lakhs. 21-22, your estimate went wrong. Today in 22-23, you are having a benefit of hindsight. What do you mean benefit of hindsight? In future, you will always know what you should have done in the past. Yes or no?
Yes, sir.
को बोलते हैं benefit of hindsight. For example, tomorrow you will pass, you will join the industry. Okay, I'm just giving an example. After 5 years, you will look back and say, oh, I did a mistake by coming to industry. If I had to be in practice by now, I could have opened my own firm, been partner and founder in my own firm, and I could have expanded it. इसको बोलते हैं, we call this as hindsight bias. Okay,
Yes, sir.
when you look back, vision is always 20 by 20, perfect vision, because the events have already happened. But if you stand on 31st March 21, event has not yet happened. So your estimate of 2 lakh is perfectly reasonable on 31st March 21. 21-22 bad debt loss of 1,50,000 should appear in the P&L because that was on account of your lower estimate that was done on 31st March 21. Do you understand?
Yes, sir.
So any estimate that is required by the previous gap, is this evidence an estimate? Is this estimate an evidence of error? Answer is, if it is not an estimate of error, is it consistent with Ind AS? Answer is yes. If yes, then use the previous estimate. I made a 2 lakh provision which was consistent with an estimate. There is no error as far as Ind AS is concerned. You will continue with the previous estimate. Did you follow?
Yes, sir.
If it is an evidence, there is no evidence of error, but it is not consistent with Ind AS, then use the previous estimate and adjust to reflect Ind AS. For example, you have made provision for bad debts based on a simple rule that dues more than 3 years, I will make a provision. But under Ind AS 109, you have to follow ECL model. This is a case where your estimates are not consistent with Ind AS. You can make a change by applying Ind AS. Is it okay?
Yes, sir.
Now, if estimates are required by previous gap and there is evidence of error, or you have not made any estimate, then make an estimate reflecting the conditions on that date, not today. Today, if you do, it will reflect hindsight bias. So go at that point of time and do an estimate without hindsight bias and record that estimate. Is it okay?
Yes, sir.
Yes. So that is all about estimates. And I think with that, accounting estimates is done, measurement of financial instruments is done, joint venture, government loan, compound financial instruments, ESOPs, yes. So with that, I think we come to an end as far as Ind AS 101 is concerned. Any doubts?
No, sir.
No? Okay. So we can conclude the session. Okay.
Yes, sir.
Thank you so much for coming online. Okay.
Thank you, sir. Thank you.
Thank you. Thank you. We can conclude the session.